Good day, subscribers. Thank you so much for joining me. Today, I am Jeremy, and this is the Financial Education Channel. And today, we're talking about the 3 stocks that my wife believes in 2017 and beyond. Now, my wife doesn't do a lot of analysis on these stocks. She doesn't look at PE ratios and income statements and balance sheets. She basically says these 3 companies are ones she believes in, ones she'll be shopping at, or whatever into the future. So what we're going to do today, we're actually going to break down these 3 different stocks, and we're going to see, is she the female Warren Buffett? Are these going to be great stocks? And we're going to actually do the analysis and the in-depth dive. So let's go ahead and get right into this, guys. So number 1 stock here is a company named Elf. Now, she told me to invest in this back in November when the stock was like $25 a share, and now it's over like $31 a share. So I probably should have, because it's performed phenomenally over the last month. But this Elf, this is a company, this is a beauty company that IPO'd recently. And as you guys see here, Elf Beauty Incorporated shares surged 56% during their first day of trading. And they IPO'd about 3 or 4 months ago, guys, trading on the New York Stock Exchange, valuing the discount price cosmetics company at more than $1 billion. The company aims to provide beauty products at prices below brands typically sold in department stores and high-end specialty stores. According to Elf, which stands for eyes, lips, face, most of its items retail for $6 or less here, guys. So this is a beauty company that sells mostly discounted cosmetics, but their packaging is nice, their product presentation is nice, their products are well received. My wife uses a product, she loves the company. So let's go ahead and look at some of the strategy they use here, guys. So e-commerce. So this is pretty impressive when I was reading this. elfcosmetics.com has the highest revenue, traffic, time spent on site, and units per transaction of any mass cosmetics brand website based on data from the Internet Retailer E-commerce 500 report and Alexa Internet. That alone, guys, is like amazing to me. When you think about how many huge cosmetics companies are out there, how many smaller cosmetics companies as well, that Elf is number 1 in e-commerce in all those different categories, I'm like mind blown by that. I was absolutely mind blown. Let's look into this some more here. So national retailers, we currently sell our products in approximately 19,000 retail stores in the United States across mass, drugstores, food stores, specialty retail channels. At Target, our longest standing national retail customer and a key beauty destination for many of our consumers, we achieved double-digit growth in retail sales from 2014 to 2015. That's very impressive. And then down here, we got Elf stores. They actually have their own stores. We are the first mass cosmetics brand with our own stores, which we believe serve one of the most effective and efficient vehicles for marketing and consumer engagement. Elf stores showcase a broad assortment of Elf products, create an environment dedicated to play beautifully, and allow us to test, validate new products. As of August 2016, we had 9 Elf stores in New York City and some other high traffic malls in urban areas. So this Elf company so far is pretty impressive, guys. They're with national retailers, as we saw, Target, Walmart, some of those places. They have a ridiculously great website. Absolutely amazing that they can be, leading in all those categories. And then they also are doing their own stores, which is something way out of the realm. No one's really doing this yet. So they're ahead of the ballgame on some of these things. But let's go ahead and look at their latest results. They just announced about 3-4 weeks ago here, guys. So Elf Beauty announced its third quarter 2016 results. So here, let's just read what the CEO has to say here. We are pleased to report strong third quarter results reflecting double-digit growth in net sales, significant gross margin expansion, and progress toward our mission to make luxurious beauty accessible for all women to play beautifully. This performance is especially gratifying as we drove sales growth on the top of a launch to 6,900 CVS stores in the third quarter. So they had a huge CVS launch. So that's phenomenal if they're in CVS now, because that's one of the biggest drugstores in the entire United States. So you got to be in CVS if you want to be a major player. Well, I worked at Walgreens way back when I was, I don't know, 17, 18, 19 years old, something like that. And I remember we used to sell so many cosmetics items, which were kind of expensive. And I was amazed that people spend that much money on cosmetics. But it's absolutely phenomenal when you can be in that many stores. Absolutely amazing. So net sales here increased 22%. So this is for the 9 months here, guys, we're looking at. The 9 months net sales increased 22% or $27.2 million to $153 million from the first 9 months of 2015. Now, that's impressive, but the problem I have here is when you look back at the most recent quarter, net sales increased only 11%. Or $5.5 million to $56.3 million. So net sales are basically increasing a lot less than they were increasing just 6 months ago. You know, they went from 22% growth in the last 9 months to now only 11% growth in this latest quarter. So I look at that and I'm like, that kind of gives me a signal of maybe the growth is starting to slow in this company. Maybe it's starting to slow way down. Let's go ahead and look at this here, guys. So net sales of $227 million they expect in 2016 for their full year outlook versus they did $191 million in 2015 and adjusted net income of $15 million this year versus $14 million last year. Once again, I'm surprised that these numbers aren't a lot higher. When I was going to look into this company, I thought like they were going to be growing like insane rates and things like that. I look at this and I'm like, that's decent growth, but for a company this size, I thought they would be a lot faster growing than this. So I'm a little surprised at this, guys, but you know, take it for what it is. So now let's go ahead and look at the stock. So it's at around $31 a share. Its 52-week high is 52-week high is $32.54. 52-week low is $23.73. They got a market cap of about $1.4 billion. They have no current PE. Their forward PE is around 84. So I look at this ELF company and I'm not that interested in that personally. Maybe I don't see the vision because maybe I need to start putting on some makeup and then I'll start seeing the vision here or something, guys. I don't see it. When I see, you know, sales growth this last quarter of 11%, and when I see that they're already kind of getting into all the big retailers they need to be in, Target, Walmart, you know, CVS and all these places, I'm not that excited about it. I'm not that excited when you're trading at an 84 PE. If they were trading, you know, maybe at a PE of 25, then maybe I'm interested a little bit. But at an 84 forward PE, I just can't bless a company like that. So the ELF one, it's not for me personally. But who knows? It'll probably go up, you know, double over the next year for all I know. My wife's usually right about these things. So her number 2 stock is Disney, the Walt Disney Corporation here, guys. So I'm going to read for you guys, some of you guys that don't understand, some of you guys just think Disney is maybe like the theme parks and things like that. There's a lot more to Disney than meets the eye here. So the Walt Disney Company, together with its subsidiaries, operates as an entertainment company worldwide. The company's media network segment operates cable programming services including ESPN, Disney channels, freeform networks, broadcast business, which include ABC TV network and 8 owned television stations. Radio business consisting of the ESPN radio network and the Radio Disney network. And then, of course, they also have their resorts, Walt Disney World Resort in Hawaii. They have the one in California. They have the one in Florida. They have a new one in Shanghai. They have one in Hong Kong. So as you read through there, guys, they own a lot of different things. They own the Marvel brand. They own Pixar. They obviously are Walt Disney Pictures as well, Touchstone brands. So they own a lot. They're into a lot of things here, guys. They are a big, huge business that basically they make a lot of their money from theme parks still in selling a lot of the items that are in some of these movies they produce. They have ESPN, which is a huge business for them. We're going to get into ESPN a little bit, and that's not going so well. And then they have ABC TV, which is one of the biggest, you know, television stations out there. So they're getting a lot of money from a lot of different ways here, guys. Now let's talk about some of the bad stuff before we get into some of the good stuff here. So one is the Iron Man, Avengers, that whole Marvel, like, I guess you could say, unbelievable time, which started around 2008 and went till about 2 years ago. That was an incredible time for the Marvel brand with the Iron Man movies that were just huge in the box office. They even made the Hulk movie and Captain America, some of those movies with lesser characters, they made those successful. Thor. It was an amazing time for the company with just knocking out of the ballpark with some of these movies. The Avengers movies, one of the top movies all time as far as grossing goes. So they nailed it. And then off of that, they also license and sell, dolls and pictures and all these kinds of things that kids buy and whatnot. And some adults buy, action figures, Iron Man. My son, I think he's got 3 different Iron Man action figures and 2 different Hulk ones. He's got a Thor one. He's got a Captain America one. Disney makes money off all that. So they don't just make money from selling the tickets. So this whole superstorm that they had over the last 6-7 years, I don't see that happening again. It's going to take time. If they were to rush another new Iron Man movie out or something, I don't think it would do very good, to be honest, because it probably wouldn't have the same main actor in it, and I just don't think it would be time yet. People aren't ready for a new Iron Man series, so it's going to take a while for those to kind of die off, and then maybe in 10 years or so, then they can bring them back and they can do a whole new thing. But for right now, that whole thing, in my opinion, is kind of dead. The whole superhero genre is kind of dead right now, and it will kind of die off for a while, just like the superhero genre always does, guys. It always does that. It has its peaks, and then it has a huge valley, and then it comes back strong. Next thing up, we're talking about ESPN here, guys. This is huge for them. They're talking about how ESPN has come a disaster. ESPN has continued to weigh on Disney's results as the NFL struggles to keep viewers. A Nielsen report showed that ESPN, ESPN2, and ESPNU lost more than 600,000 subscribers from October to November. From October to November, 600,000 subscribers. ESPN's NFL ratings have suffered 17% decline this season, according to Nielsen data as of last week. So let's break some of this down here, guys. I was a core ESPN consumer for a decade, if not more than a decade. I would watch ESPN hours a day. ESPN began to lose me as the internet started to evolve and some highlights started to be shown on YouTube and a lot of other platforms. They also started to lose me when they started focusing more on just talk and less on highlights. And then they also started to lose me when basically they started to let some of their main characters go, the main people on the shows and whatnot. For instance, Monday Night Football used to have Mike Tirico. He got signed by NBC, so ESPN let him go. Skip Bayless, who did the First Take show, he got signed from Fox Sports 1. Berman, Chris Berman, he's getting a lot older now. So they lost a lot of key people that people like myself loved to see and enjoyed watching and would just watch because we liked that person. They were funny or they were entertaining or whatever, how they announced football highlights. Also, the football games they've had this year have been absolutely appalling. I can probably name maybe 1 or 2 football games, and I love football, and I probably watch 1 or 2 football games the entire season on Monday Night Football this year. They've had horrible games, guys, straight up. So ESPN, it's no surprise to me that they're suffering. When you let a lot of key people go from your work, and they get signed to other companies, that's going to hurt you. When you stop focusing on highlights and you just want to talk all the time, try to watch ESPN that other night. They talk for 10 minutes straight about this Klay Thompson's game that he had 60 points in. I wanted to see the freaking Klay Thompson highlights. They talked for like 10, 15 minutes and didn't show one highlight. I'm like, what am I watching? What am I watching? So people like me, they've lost. And I could care less if I even had ESPN, guys. I'll be completely honest with you. And I was loyal to them for 10 plus years. So they're in big trouble with ESPN. They're talking about selling it now. Who knows? It's something to take into account when you're talking about Disney, though, because it's a big part of their business. They're getting a lot of revenue and profits from them still to this day. Now, let's talk about some good stuff. They got Rogue One, the Star Wars movie, coming out. This is the second movie that Disney will be producing from the Star Wars genre. It's coming out actually December 16th, so very soon here, guys. This could be a huge one for them. The first movie did very, very well, and they made a lot of money from box sales on it. They also made a ton of money from, like I talked about, toys and all those kinds of things, merchandise that they sell from the movie. Now, this new movie is coming out, like I mentioned, December 16th. And the budget's $200 million here, guys. It amazes me that they put this much money into one movie, $200 million. So they got a lot of money to recoup before they even start to make a profit. I don't think this one is nearly as hyped as the first Star Wars movie that came out last year from the Walt Disney Corporation, but we'll see how it does. It should do good, don't matter what, because of Star Wars. The question is, does it do good or does it do great? Because that will affect Disney's results in a major way. I can guarantee you that. Next positive news is Disney Shanghai opened, which just opened, I believe, about 4 or 5 months ago. This is also very good news for the Disney Corporation because we know the middle class in China is growing. We know it's growing, guys. And the Chinese, they would love their own theme park. Now they have their own major theme park in mainland China, in Shanghai. So it'll be fun to see how this investment basically plays out over the next 5, 10, 15 years because, of course, the middle class is just growing in China. So there'll be more and more people that can afford to even go to this theme park in the future and more people that can, spend more money in the theme park as time goes on. So it'll be very fun to see how that one plays out. That's another very good positive for them. Now, let's look at this income statement here. 2014, they did over $48 billion. Last year, they did over $55 billion. So great revenue growth for a company this size. They grew net income there at the bottom from $7.5 billion to $9.3 billion last year. So I see this income statement. I say that's very impressive income statement. I'm very impressed with this income statement. On the revenue metrics, on the net income metrics, it's amazing a company this size and this established is growing this well. I'm very impressed right now, guys, very impressed. Now, the balance sheet, let's check out this. So we're focusing on October 1, 2016. We're focusing on their cash and cash equivalents, which is $4.6 billion. They have no short-term investments. Next category down, we're looking at long-term investments there. Long-term investments of $4.2 billion, so very impressive. Now we're going ahead and looking at liabilities here, guys. Short/current long-term debt of $3.6 billion there. And then we're looking at long-term debt of $16.4 billion. That's just a few lines down there, $16.4 billion. So overall, when I look at this balance sheet, I'm not very impressed. I would call it an average balance sheet for a company this big. Sometimes companies this big that build resorts and whatnot, they have more debt than they do cash and whatnot. So I would just grade this an average balance sheet for a company this size and in their industry they're in, guys. So average balance sheet. Next up here, let's look at this latest quarter they reported. The Walt Disney Company today reported earnings for its fourth quarter and fiscal year ended October 1st, 2016. Diluted earnings per share for the fourth quarter increased 16% to $1.10 from 95 cents in the prior year quarter. I look at this, guys, and I'm very impressed. Now let's look at what the CEO had to say. We are very pleased with our performance for the year, delivering the highest revenue, net income, and earnings per share in Disney's history, said Robert A. Iger, Chairman and Chief Executive Officer. The Walt Disney Company. Fiscal 2016 was our sixth consecutive year of record results, highlighted by our opening of the Shanghai Disney Resort and the phenomenal success of the return of Star Wars to our studios. Record-breaking $7.5 billion in total box office. Absolutely amazing, guys. Absolutely amazing. Phenomenal growth. I'm surprised they grew like that last quarter. I really am as far as earnings go. But there's a little more deeper we have to dig here, guys. Now, look at this quarter here. Media networks down 3%. This, once again, comes as no surprise with the hurting ESPN ratings and some of those things. The other thing I was a little surprised about was parks and resorts. Look at it, only went up 1%. Now, the Shanghai Park was open the full quarter. The Shanghai Park was open that entire quarter, and they only had a 1% increase in revenue. I'm very surprised at that, guys. I thought the Shanghai would at least push revenue up 5-10% for the parks category. So to see 1%, that kind of surprised me. It really, really surprised me. But let's see, is Disney a deal? So it's trading at about $101 a share. It has a market cap of $161. By the way, its 52-week range is $86 on the low end and $114 on the high end. So it's kind of toward the middle there. PE of 17.75. They do pay a dividend of about 1.5%. and they have a forward PE of just over 15. I look at Disney and I say, oh, I just want it a little lower. Go to the 90s. Go to the 90s, I mean like the low 90s. Go to the low 90s, and then I'm very interested in this one. Very, very interested. Right now, it's just a little higher than I wanted at. A little higher. You know, if that forward PE can come down to a 14, a 13, and a company is like Disney that's as big as it is, I look at that as a safe company that has a chance to expand its dividend yield over time, and I look at that as it could be a very good investment for 2017 and beyond. But I want it a little cheaper than it is right now. Last one, stock number 3 is Ulta Salon. So those of you guys who do not know Ulta Salon, basically they sell every type of cosmetics you could possibly imagine. As far as makeup goes, they also sell tons of things like shampoos and conditioners. They have a salon in their place. They have a place where you can get your nails done, a place where you can get a facial done. All these sorts of things all go on in an Ulta store. So very impressive company. Their stores are very nice. I've been into them before. They're very well run. So let's look at the revenue here on this income statement. They were at $2.6 billion in 2014. Last year, they did just under $4 billion. That's an insane increase in only 2 years. Net income, they're at the bottom, $202 million in 2014, $320 million last year. I look at that and I'm very impressed. Very impressive growth by this Ulta company. And it's not even like they built out that massive amount of stores in that amount of time. They're just growing comp store sales and some of those things very well, and then building stores on top of that in new markets and whatnot. So this is very impressive to see that kind of growth. Let's look at that balance sheet now. Balance sheet, we're looking at only 2016 here, guys. So cash and cash equivalents of $345 million. Short-term investments of $130 million. Next category down, we're looking at long-term investments. They have no long-term investments currently. Now we're going down and we're looking at liabilities. Liabilities, they have no short/current long-term debt, so that's phenomenal. And then lastly, we're looking there at long-term debt, which they have no long-term debt at all. They have stockholders' equity of $1.4 billion, which you will see at the very bottom. So I look at this balance sheet and I say that's a really good balance sheet. Really good. That's exactly how I describe it. It's a really good balance sheet. No debt. And all that cash and short-term investments, very impressive, Ulta. Very, very impressive. Now, is this company a deal? It's at $254.40 a share. Holy smokus. So 52-week range of $146 all the way up to $278. A market cap of $15 billion, a PE of 42, and then no dividend. We have a forward PE of about 32 on this company. So I look at Ulta and I'm like, man, that forward PE is a little high. That forward PE of 32, I don't know. And then I looked at this last quarter that they reported last week. And I'm like, what? Look at this quarter here, guys. Net sales increased 24.2% to $1.1 billion from $910 million in the third quarter of 2015. This is the most impressive. Comp store sales, so comparable store sales, sales for stores open at least 14 months, and e-commerce sales increased 16.7% compared to an increase of 12.8%. The 16.7% comparable sales increase was driven by 11.1% growth in transactions and 5.6% growth in ticket. I look at this, guys, and I'm like, are you freaking kidding me? This is phenomenal growth. Absolutely amazing. And then I look down here a minute and I see e-commerce sales grew 59.1% to $73 million compared to last year's quarter. I look at gross profit, that increased as a percent. I'm like, wow, that is pretty impressive growth there, Ulta. That is really impressive. So I look at Ulta, and unfortunately, once again, I want it for a cheaper price than it is. If this stock could drop under $200, then it piques my interest. I love the growth. I love it. It is freaking phenomenal. But there's two problems I have. I have a forward PE of 32, which in retail, it's hard to sell me a 32 forward PE when you're a retail company, right? Other problem I have is I think Amazon will begin to really push into this category and will really hurt places like Ulta in the long run. And it's just a slow cuts, Amazon will do. I think this is going to be a big focus for Amazon here in the future. I think they're already starting to focus on it. It has not affected Ulta yet. Will it affect in the future? I think so. I really think Ulta will be affected by this in the future. How much? That's a whole nother question there. So Ulta's not quite a buy for me yet. If this could drop under $200, then all of a sudden I'm like, okay, I like this one. I think it's a well-run retailer. I really do, and I believe in the future, even though it will get hurt by Amazon. But I just can't get over the fact that it's a 32 PE and it's a retailer that, in my opinion, doesn't have a mass amount of stores. It can still grow over the next decade, let's say. So those are the 3 stocks that are my wife's. I'm glad I broke them down for you guys. Let me know if you like any of these 3 stocks. I would love to hear it. If you enjoyed this video today, hit that thumbs up button, guys. And if you came across this video and you have not subscribed yet, you may want to. I talk about personal finance on the channel. Talk about entrepreneurship. I'm an entrepreneur, and we talk the stock market the most on this channel. I break down stocks every single week. Thank you for watching, guys, and have a great day.